Nitin Raheja is now joining us. In fact, Nitin and I were having exactly this conversation last evening at the sideline. Nuresh, Kunal, welcome to the show, both of you as well. But Nitin, let's take off from there. Yesterday we were talking that it's not very sexy to talk about banks, right? If you ask a doubler in next 3 years and somebody says SBI le lo, नहीं कुछ और बताओ, because people are not really, SBI double होगा 3 साल में. Of course, the profits growth is very high, but people are not finding it sexy enough. But it appears that flows are now directed towards bank. What are your thoughts? You were bullish on banks last afternoon as well.
We've been bullish on this whole sector for some time now. Unfortunately, technically, because it's been an over-owned sector, especially it's a very liquid sector, and it was over-owned by the FPIs. There was a time years back when, because there was this 20% ownership limit, there used to be a block of banks which used to trade at premiums, the FPI, what we used to call as the FII block. Now it's been the reverse because they've been selling down India in the last few years. We've seen this whole, and this has happened at a time when, you were there yesterday, and we heard the RBI governor and we heard Mr. Khera talk about how strong the fundamentals of the banks have become in terms of capital adequacy ratio, in terms of the whole credit cost coming down to all-time lows. I think the banking balance sheet, I don't see as being as strong as it is today in the last decade. And, if we are going to talk about the strong economic growth, like you said, I think clearly banking is the sector that is going to participate. And when it does participate, one of the reasons it's such a large chunk of the Nifty ownership in the Nifty or indexes is the sheer size of profitability that comes out of the banks is immense. So, and when you look at valuations, these are trading at, if you take the PSU pack out, private sector banks especially are trading at the kind of valuations I have not seen for a very long time. So I think it's a very interesting place to be in, where I think in a market where everything is run up, I think value clearly lies out here.
That's exactly the question that we posed to all of the experts in the channel yesterday, from Rhythm Desai. We also spoke with Manish Chokhani just last evening on the sidelines of the ET Now Leadership Dialogues, and they all believed consensus call is banks because that's where you have valuation comfort. And guess what? It's begun playing out today itself. So let's hear out Rhythm Desai's view on financials.
Financial services led by the lending large lending businesses, and I'll emphasize large because the environment is very favorable for large, not necessarily the small. And capital market businesses, financial services overall, I think is set for a major leg up. It has been lagging the market so far. I think that's where the valuations are looking quite good. And there is a very strong earning cycle coming. Let me lay down the backdrop. So I think the regulator is being very vigilant, which is not how regulators behave when the cycle is still so early, right? So they are ensuring this is a long cycle. It's not going to end so quickly like it did in the first decade of this millennium, when very quickly, lending just shot through the roof and NPL started building up. So it's a long way before we get credit costs. I think margins have stabilized. We're through this rate cycle. We don't see the RBI in a hurry to cut interest rates. And the reason is that they are steadfast on their 4% inflation target, which will take some time to be achieved. And growth is fine. So what's the purpose of cutting interest rates? I know a lot of people say India needs to cut interest rates. Why? We don't need to. We have got good growth and we've got stable inflation. So the interest rate is just about right. It's not like the US, which is slowing down in terms of growth and therefore may have to ponder over rate cuts. India is not. If anything, India is going to accelerate in terms of growth. So I think the rate environment is spot on. So with that, the banks, I think, make more money.
This center point of the country will pass through financials. And it's not just the banks, the wealth management companies, the mutual funds, the stock markets. Enough range of things to play there. Historically, each time the government vacated a sector, the profit pool came to private sector, and they tended to be natural oligopolies. So it's happened already in telecoms. They vacated telecoms, they vacated airlines, and so on, like they did in the past with banking, or they did with media, and so on and so forth. So all that is also still coming. And the whole policy push is manufacturing. We want to go from whatever 16% of GDP to 25%. So you can expect all the policies to come directionally in favor of whether you're doing semiconductors, your PLI will come for semiconductors, electronics, pharmaceuticals, chemicals.
For us, it is, as of now, it is 12% of our business, of our balance sheet comes from our international operations. And we have an ambition of scaling it up only. We will continue to remain in the geographies where we are, and we are selectively looking at it, the other geographies also where we can expand, where there are opportunities, so that is very clearly a focus area for us. And in the medium term, we will like to increase our international banking book from 12 to at least 15%.
That is SBI for you, the new avatar of SBI, which is doling out, massive, copious amount of liquidity in the form of profits and racing ahead of many private sector enterprises, even higher profitability than Reliance now, moving towards 900. But for a moment, I'll go back on the Bank Nifty breakout and talk also about not only HDFC and IndusInd, which are leading it, but the smaller ones. Look at RBL, 5%, back to 270, it went to 220 in the meantime. Kunal, what is your reading of the Bank Nifty breakout today? How is it different from the June 4th move, where everything else was also rallying? But today, rest of the market is largely quiet, but this one is making a big move.
I'll tell you, we started the show, the Bank Nifty open interest was just 9.5% plus. Right now it's 14.5% plus.
Oh my God.
So in just the last 15 minutes, there's been 5% jump in the open interest for Bank Nifty. That itself tells you that this move is backed by strong volumes, the point which you were asking earlier. Yeah, I think now what happens is that, with this kind of move, we establish one trend, which is the leadership stocks. And that comes back into the likes of HDFC Bank, maybe to a larger extent, Axis Bank also could probably be a breakout candidate over here. And now would probably be a point where many of the laggard stocks, the likes of Bandhan Bank, RBL, IDFC First Bank, in terms of price performance, these stocks can make a comeback. Look at it this way, for the first time, I think Kotak Bank has also come back to a breakout about 200-day moving average. Even after that sharp correction, the stock had seen almost a month back. So that itself tells you that it's now time possibly that the underperforming stocks can also move up higher. So I think the ball is open. It depends on what kind of stocks one is looking out for. Leadership stocks, I would still believe HDFC Bank, Axis could be the key candidates over here.
Kunal, that's the underperformers, the large cap private banking names. What about the PSBs, which in any case have done well?
So today, for the first time, I think except for SBI, most of the other stocks are actually lagging behind. But then I would believe that it could be maybe one step back for now for the PSU banking stocks. But when you look at this maybe 1 week, 10 days later, I think you probably might see a net stronger price performance, which may come back into the PSU banking names. So I think what today's breakout move indicates is that the mojo is coming back into the banking stocks, because look at this way that none of the other stocks in the sectors is where traders are focusing, because the liquidity is just getting driven completely, or the more trading volumes is completely getting driven into this.
Just imagine 1500 points. I mean, we started the show, 3 hours back, you were crossing 51. 900 pure added points after adding the show, almost 1500 now. But I'll go back to the smaller bank. Nuresh, I remember discussing this entire, IDFC First from 25 odd bucks went to about 100, then came back to 40, 44 when they had cut their growth guidance from 25 to 20. Now it's at 82 right now, trying to come back. Is it going back to 100 now? Is it a good time to get into some smaller private sector names? RBL and IDFC First.
So I've been recommending the banking names as such for the last 1 week, and today morning I covered the Nifty Private Bank Index, which was on the verge of a breakout at 25,000. We've already gone up to 25,800. The whole sector looks interesting, and specifically private banks. So if you look at IDFC First Bank, after making that move to 100, the stock went to sub 80 level, stayed there for the last many weeks, and is now making a comeback move. Yesterday was a large volume day. RBL Bank has also spent a lot of time around this 240, 265 mark. Today it's a breakout with good enough volumes. So looks like finally, after COVID, this is the first time we are seeing outperformance on the Bank Nifty on even a daily basis or a weekly basis compared to the Nifty as such. So looks like a start of a trend across the whole private banking name. So the focus remains, even now, if you look at it, ICICI Bank today at 1160 is still a percentage away from an all-time high. You have Axis Bank closer to an all-time high. You have IndusInd Bank, which is just about to break out. So I believe private banks could continue this rally, and we could see flows come back from the FIIs. This is the first indication. So my view is private banks and smaller banks also should do well. So it's a pick your choice category in the whole banking space.
Okay, that's that about banks. But look at the lagging part of the market also today. So you've got a Bharti, which is down about 2%, Hindalco, which is down, Maruti, L&T, Titan has cracked 3.5%. The Adani names as well, not really performing well. They're the underperformers. ONGC, ITC, some of the pharma names. And Reliance also continues to be a drag, even though it started off the day just about okay. But from there, it slipped pretty much around the low point of the day. That's true about the pharma space as well. And IT, while you've got spots of green for an HCL, for a TechM and Infosys, but not pretty much across the board. Wipro and TCS, LTIM still continue to be struggling. Nitin, outside of banks, which we've already addressed, where is it that you sense profit taking would happen? I mean, today you are seeing the small and mid caps, your capital goods, some of the consumption names, defense names, they are seeing some serious amount of profit taking. But is that a trend in place? Do you sense that?
It's very difficult to say whether, this is a trend or profit taking is taking place, because don't, forget that old saying that talks about that markets can remain irrational more than you can remain solvent. The point of the matter is that a lot of these names that you talked about in defense, in capital goods, are trading at very rich valuations. But having said that, clearly business visibility is also very strong for each of these names over the next 2 or 3 years. So I think even if you do see corrections, it's going to be more like corrections that need to be bought into. So for example, in a lot of these companies which are execution focused or based on order books, if there is a delay in one quarter, or there is some issues as far as execution, you could see corrections happen out there. But clearly, because the longer term story is so strong, you will see them bounce back quite fast. But the margin for error is very low at the present moment in these businesses. I mean, we are rather more comfortable in a lot of the consumer discretionary names, where structurally it's a 5-10 year story that is happening.
That's quite interesting. Okay, Nitin, stay with us. Lots more to talk about. We're going to take a very quick break, but time now for word coming in from the chairman of the Adani Group, Gautam Adani. In the age of policy continuity, the government is largely focused on infra development across the board. Here are excerpts from his speech at CRISIL's annual Infra Summit.
If the period between 1991 and 2014 was about putting down the foundation and building the runway, the period from 2014 to 2024 has been about the aircraft taking off. And a strong example of this takeoff is the National Infrastructure Pipeline, the NIP program. The core essence of the NIP is its integrated approach involving participation from both the public and the private sectors, with the funding model divided between the two. I consider the NIP program that has earmarked a projected investment of rupees 111 lakh crores over the period of FY20, FY25 as a benchmark of how a government can put in place a national view of over 9,000 infrastructure projects across sectors like energy, logistics, water, airports, and a social infrastructure. The fact is that the infrastructure required for energy transitions and the infrastructure required for our digital transformations are now inseparable, as the technology sector becomes the largest consumer of the precious green electrons. My dear friends, we are well aware that there is no greater multiplier for GDP growth than that delivered by infrastructure investment. It is the foundation that allows efficient and frictionless flow the flow of goods, electrons, molecules, data and people. And all of these flows are either core business driver or enable adjacent business for the Adani Group.
Right. Nitin, I'd like your thoughts on one of the points which is coming up again and again in our conversations. In the last 2-3 days, we've spoken to some of the finest minds in the Indian ecosystem from corporate India, Mr. K.V. Kamath, Subramaniam ji, Dr. Subramaniam from the IMF. Of course, earlier he was the CA as well. And the point which is coming out is that the country's economic model of growth, they are attempting to have higher than average growth, anywhere in the range of 6 to 7%, but trending higher with a moderate inflation environment of say 4.5%. If indeed this happens, what does it do to the capital market on a 3 to 5 year, say 2030, a view from between now and 2030, in your view?
I think clearly the capital market is looking at a very strong trend going ahead. You're right. You will have these periods where in the capital market where valuations go a little ahead of fundamentals, right? But I think the key important fact is that I think someone made a very valid point yesterday at the conference yesterday, which talked about the fact that the capital markets has two legs going for it. One is a PE re-rating and the other one is growth, I think. And he talked about how PE re-rating has largely happened because when we compare it to historic. So now I think a lot of it is going to be driven by growth, and the faster the growth and the better the growth, we should see the capital markets trend upwards. But you would have periods of time when you get into a consolidation phase, or there is a global event which would, impact the markets in the short term. But structurally, if you look at where we stand, and capital markets being a proxy for the GDP and growth, you do see it's a good place to be. It's a great way to compound your money. And more importantly, I think one of the key elements is that as far as the whole equity culture is concerned, I think it's yet very, very nascent, considering that an average Indian's household asset, equity is hardly around 5.8 or 6%. So I don't think we are over-owned as far as equity goes. And as an asset class, I think the big change, according to me, happened in COVID. You are in 2020 in COVID, and you are a digital economy which has been well connected using the national ID card linked to online brokerages. And anybody who came into 2020 and this young population with a hungry appetite for risk, who participated, is in the money, and in the money big time. I don't think this bunch of people are going away from equities as an asset class. So I think we are only going to see more and more conversion. So you have growth, B, you have more and more demand coming from for equity as an asset class. So and plus, if India becomes an asset class globally, you will see the weight of India going up in the MSCI. Don't forget, we are at 18% and China has come down. But if we are going to go faster, there's no reason why our weight in the MSCI will not go up. And that's going to mean more money coming into India. So all in all, I see, from a capital market perspective, a great, time going ahead.
Okay, Nitin, great to have you on the show. In fact,
if you like this video, then like, share and subscribe to ET Now.